Picture these scenarios. A human trafficker walks into a foreign bank to deposit a suitcase full of cash earned illegally. A politician opens an anonymous company abroad to hide money stolen from public funds. A businessman dodges taxes by transferring his profits overseas to a shell company located in a tax haven. In all these cases, no one asks where the money came from, and poof, it's gone. This magic trick is called an illicit financial flow, or an IFF. Studies conducted by Global Financial Integrity show that in 2013 alone, $1 trillion in IFFs left developing countries worldwide. That's trillion with a T. Of that, a staggering $482 billion was from Asia alone. Wait, stop and think. What we're saying is that almost half of all the money lost worldwide to IFFs comes from right here in Asia. Let's take a trip to South Asia, home to the practice of Hawala or hundi, the informal banking system unique to this region. Money is transferred often between countries through a trusted network of Hawaladars. There's no record or contract, and often money doesn't even exchange hands. In many cash-based economies of South Asia, this works as a cheap and reliable system of remittance minus the red tape, which in turn makes it easier for money launderers to slip through the gaps. Developing countries also lose money to the practices of trade misinvoicing and transfer mispricing that together account for $160 billion annually. Through trade misinvoicing, a company can dodge taxes by artificially lowering its own profits on exports, or it can bloat invoices on imports, allowing large amounts of capital to be shifted abroad. 60 to 70% of all world trade takes place between global corporations and their own subsidiaries. If a company sells its goods and services to a related entity at the true price of that product, or at arm's length principle, it is perfectly legal. However, corporations avoid taxes by manipulating the prices of goods and services sold to their related entities located in other countries, often in tax havens. To understand how it works, let's follow the trade route from a parent company based here to its subsidiary located here, and in turn to another out here. Ultimately, this branch trades with another located in a tax haven. This way, the parent company dodges taxes and keeps its profits safe within the family. This brings us to the wonders of tax havens. Countries that pamper businesses with low or close to no taxes, secrecy in various forms, avoidance of criminal laws and financial regulations, and an escape from any sort of accountability. Switzerland and the City of London are famous offshore jurisdictions to hide wealth. But recently, a large portion of offshore wealth originating in Asia-Pacific countries has been finding its way to Singapore and Hong Kong. In fact, Singapore and Hong Kong together accounted for 16% of the global offshore wealth in 2014. This is money that should go towards national welfare, especially in poorer nations. Instead, it's going into the pockets of the already wealthy. Illicit wealth and flows are a complex set of issues, but there are solutions. A robust financial information exchange system should be institutionalized at a global level to help countries track their money. Asian countries should work together to set up a forum for regional cooperation on tax and transparency matters. National governments should aim to identify sectors contributing most heavily to IFFs, and this way attempt to curtail the generation of illicit money in the first place. With these few steps, we can work together to keep our nation's wealth where it belongs, with the people.